Hey everyone, and welcome to today's Explainer. If you've been glancing at your portfolio lately and feeling that very specific 2026 economic anxiety, trust me, you are absolutely not alone. We're seeing wild swings pretty much across the board right now, and a lot of us are feeling, well, completely disillusioned with the markets. But what if I told you that in an era of space tourism, hyper-advanced algorithms, and wildly volatile digital currencies, the absolute smartest, most secure investment you could possibly make today might literally just be dirt. Yep, dirt. Today, we're breaking down the truly fascinating findings from The Wealth of the Soil, a guide to farmland investing, to unpack exactly why institutional money is quietly pouring into agriculture. Okay, let's dive into our roadmap for today. We're going to start with the 2026 Safe Haven, then move into the mechanics of passive harvests, cover investing without a tractor, take a hard look at managing climate and risks, and finally wrap up with building your farmland portfolio. All right, kicking things off with Section 1, the 2026 Safe Haven, a modern anchor. So the core problem modern portfolios face right now is this massive volatility versus our basic need for tangible, real-world assets. Just think about it. On one side, you've got traditional stocks and crypto. They're driven by sentiment, algorithms, and 24/7 news cycles, right? They can literally lose half their value overnight just because of a single social media post. But on the other side, you have the tangible, stable earth. Farmland is outperforming those traditional assets in our current turbulent economy for one very simple, inescapable reason. You can't eat a crypto token. People are always going to need food, which means the underlying asset producing that food holds an intrinsic, undeniable value. And that brilliantly illustrates our next point, which all comes down to a single number, zero. That is the ultimate scarcity factor. I mean, they aren't exactly printing new lands in a factory somewhere, are they? While our global populations are continuously rising, meaning way more mouths to feed, the actual amount of farmable land is decreasing thanks to urban expansion and development. It's honestly the purest example of supply and demand economics you can find. When supply is strictly capped at zero new growth and demand is absolutely guaranteed to rise, the value of that existing asset is naturally driven upward. Which brings us to this crucial concept you really need to understand. Farmland isn't just a stagnant place to park your cash. It's what we call a dual return asset. This is huge because it essentially gives you two different ways to win. You aren't just buying a plot of land and crossing your fingers that it'll be worth more a decade from now. You also get an annual rental yield from the farming operations happening on that land, completely on top of the long-term appreciation of the dirt itself. Basically, you're getting paid cash while you wait for the asset to grow. Moving on to Section 2, Mechanics of Passive Harvests, Earning Without Farming. Now, you might be wondering, how on earth do I get that annual yield if I don't know the first thing about driving a combine harvester? Well, the secret is, you don't actually have to get your hands dirty at all. Investors earn this steady cash flow through a couple of main structures, primarily crop shares and fixed lease agreements. In these setups, it's the experienced professional farmers doing the heavy lifting. They're running the tractors, planting the seeds, managing the day-to-day operations. You, as the investor, are simply leasing them the ultimate resource they need to run their business, the land itself, and securing a steady, completely passive cash flow in return. But wait, what about bad weather? It's a totally fair question. Well, the source material points out something incredible. Modern agriculture isn't just relying on the farmer's almanac anymore. The deployment of climate-resilient crop technology acts essentially as an insurance policy for your dividends. By utilizing generically optimized, drought-resistant, or flood-tolerant seeds, farmers are actively protecting their yields, and by extension, your passive income from wild, unpredictable weather events. So what does this all mean for the big picture? The crucial takeaway here is the incredibly low historical correlation between farmland, the S&P 500, and the traditional housing market. When the stock market takes a nasty nosedive, or when the residential housing bubble pops, farmland historically just kind of keeps chugging along on its own steady path. Why this matters for your specific nest egg is pretty simple. True portfolio diversification isn't just about owning a bunch of different tech stocks. It's about owning entirely different asset classes that won't all crash at the exact same time. Let's jump into Section 3, Investing Without a Tractor, Methods for Every Level. Now, what's really interesting here is how we transition from theory to practical application, because today there are investment methods tailored for absolutely every level. If you want high liquidity, like you want to be able to cash out quickly, institutional-grade real estate investment trusts, or REITs, let you buy and sell shares of agricultural portfolios on the open market super easily.
Now, if you have really deep pockets and want total control, direct physical ownership gives you the actual deed, but obviously that requires high capital and a ton of management. And right in the sweet spot for a lot of everyday investors are fractional platforms, which balance those two extremes by pooling resources together. And if you're sitting there thinking you need millions of dollars to get in on this, think again. $1,000. That is the number that should really wake up retail investors today. The massive rise of these fractional ownership platforms means the old barrier to entry has completely crumbled. You can literally start building a diversified, income-producing agricultural portfolio with as little as $1,000. You are buying actual shares of a specific, heavily vetted farm. And for those of you worrying about the logistics of owning even a fractional share, don't stress. The industry has evolved to offer complete peace of mind. Turnkey management firms are baked directly into these platforms. They handle absolutely the whole shebang, from the initial soil testing and securing the farm releases, right down to the ongoing physical maintenance of the property. So you will never be asked to drive out there and fix a broken fence or check the pH balance of the dirt. The physical asset is entirely managed for you, hands-free. All right, let's move into Section 4, Managing Climate and Risks. Maintaining balance. Of course, we need to be real for a second. No investment is without its hurdles. According to the research, there are 3 primary pitfalls you objectively must consider. First up, water rights. Land is pretty much useless if you aren't legally allowed to irrigate it. Second are interest rate sensitivities. These can seriously affect the borrowing costs for the farmers operating on your land, which could potentially impact their overall profitability. And finally, overarching climate shifts that could alter a region's historical growing seasons. It's absolutely essential to weigh these factors carefully before making any allocations. However, risk mitigation is where smart investing really shines. Instead of just avoiding agriculture altogether because of changing weather, savvy investors are mitigating these risks by strategically targeting very specific geographic zones. They're actually identifying regions that are poised to benefit from changing rainfall patterns and these specific 2026 climate shifts. It's a highly active, data-driven approach. They're mapping out where the most productive soils will be tomorrow, not just relying on where they happened to be yesterday. Furthermore, mitigating risk also comes down to how the land itself is treated day in and day out. This brings us to regenerative farming. The source material makes this crystal clear. Employing practices that rebuild organic matter and restore degraded soil biodiversity is not just some feel-good environmental choice. No, it is a strictly critical financial tactic. Healthy soil produces better yields, and it actually holds more water. If you want to preserve and grow the long-term value of your asset, regenerative practices are absolutely essential. Which leads us perfectly into Section 5, Building Your Farmland Portfolio, the Action Plan. Let's take everything we've learned so far and turn it into a concrete strategy. When you're looking at a potential farm investment or jumping onto a fractional platform, you need a strict vetting checklist. Number 1, verify the water rights attached to that specific deed. Number 2, review the historical crop yields for that specific county. Number 3, take a hard look at the track record and the fees of the turnkey management firm running the platform. And number 4, confirm the length and terms of the leases with the actual farmers. Stick to this checklist and it'll massively empower you to separate the truly great opportunities from the mediocre ones. And beyond just the direct returns, you've also got to factor in the structural benefits. Farmland offers some incredibly powerful tax hacks that are pretty unique to real estate. For instance, you can leverage depreciation on infrastructure. We're talking things like irrigation systems or storage silos to offset your income. Plus, utilizing tools like 1031 exchanges allows you to roll the profits from selling one farm directly into purchasing another one, completely deferring your capital gains taxes. That right there is exactly how generational wealth is compounded over decades. As we look to the horizon, I want to leave you with a really provocative thought to chew on. We are right on the cusp of an incredible agricultural revolution. With the rapid advancement of vertical integration, where the farms actually own the processing and distribution, combined with the absolute explosion of AI-driven autonomous farming drastically lowering overhead costs, how will these sci-fi realities redefine future land valuations? The dirt beneath our feet is getting a massive, unprecedented technological upgrade, and understanding that transformation might just be the ultimate key to your future exit strategy. Thanks so much for joining me for today's explainer on the wealth of the soil. Catch you next time.